G'day guys, Seeney here, and as we wrap up the end of this financial year, I thought it'd be worth having a look at some of my best performing stocks. So thank you guys so much for tuning into this video. Please make sure you like and subscribe to the channel. Really helps to get these videos out to more people. So as the end of the financial year rolls around, everyone's doing their tax, and it's important to look at what you've bought and sold and things like that, and the performance also of your stock portfolio, which is what I'm gonna be having a look at today. So as we've seen in the last couple of years, the stock market has gone absolutely crazy. You know, the returns that that people have seen have just been off the charts. So out of the best performing stocks that I have, I'll be going from the lowest percentage gain to the highest percentage gain. And at the end, I'm also going to include a bonus stock, which is actually the worst performing stock. And I will explain why. So without further ado, let's get into it. So we're gonna start with one of the stocks that I purchased during the depths of the pandemic, and that was Wynn Resorts. Now, Wynn Resorts, if anyone doesn't know, is a casino company. You know, they operate a casino not only in Las Vegas, but also Macau. And this particular stock was absolutely crushed during the pandemic, obviously, because all of these places were shut down. You know, they just couldn't operate. You know, we've seen it all around the world. We know the story. So while everyone else was selling these stocks and just trying to get rid of them as fast as possible, I was continuing to buy. So since purchasing this stock, I've actually sold out of this position, but we returned 52% on our initial investment, which is a great return considering the amount of time. And you know, a lot of people talk about, you know, time in the market is much more important than timing the market. I think both of those are important. If there's a great opportunity that arises, then it is really important to jump on that as much as you possibly can if it presents itself, because these opportunities don't tend to last very long. And as you'll see very soon, that is the case. Okay, so now the next stock that I'm going to talk about is Crowstrike. Crowstrike is a cybersecurity company. Fantastic one at that. Revenue growth is just off the charts. Amazing company. And this is a stock that I've just been buying you know, over time, because I just think it's a great company. It's going to continue to grow and be an absolute beast as cybersecurity continues to become more important. So far this financial year on this stock, we are up 56%, which is a return I am very happy with. Now, following on from that is one of those stocks that, you know, kind of flew under the radar for a long time. And it's only just now that's starting to get a little bit of attention on Wall Street, and we're starting to see it rise up. And this company is a cloud company. You know, it's basically storage and, you know, pretty steady growth rate of about 15% revenue growth every single year, you know, which is nice and stable, and they're going to become very profitable soon, very diversified business. And that company is Dropbox. Now, since I started buying Dropbox around $17, $18 a share, it's now up over $30 a share. So very happy with the return so far, and we are up 59%. Now, moving on to the next stock. This is a stock that I actually started buying before the pandemic. So that's really important to note, because this particular stock is a stock that got absolutely crushed. It was sitting around the $50 to $60 a share prior to the pandemic, and then of course the entire world shut down. And as a result, this particular company, being in the leisure space, got crushed as well. Sometimes even trading down around $7 to $8 a share, all the way down from 50 or 60. You know, it's a massive reduction. So this particular company is Carnival Cruise Lines. Now, I'm actually up quite big on this stock, which you would think is quite counterintuitive because it's gone down so much. But since then, it has had a rebound. And this is the importance of dollar cost averaging into a stock at good prices. So once the stock began to fall, I just watched it continue to fall until we got to, I guess you would call, peak fear in the market. And during that time, Carnival Cruise Lines was trading at about $7 or $8 a share. So I was picking it up at 14, I was picking it up at 12, and I was even picking it up at $8 a share. You know, it was just such a great deal at that time. And, you know, people were just scared that they were going to go bankrupt. But knowing the size of the company, how big it was, and the great balance sheet that they had at the time, they were going to get through this. So it was an investment that I was pretty confident to make. And since then, the stock has rebounded to around, I think, $26, $27 a share. I sold out when the stock was at $28 a share for a 70% gain. This is the importance of being able to dollar cost average. So even knowing I'd bought in at the top, I still believe that the company had a lot of potential and that it had definitely been oversold. So it's important, if you are confident in a stock, then you want to be continuing to buy it regardless of the price.
Here we go, come on, push it, buying the dip, buying the dip. Here we go, come on, push it, buying the dip, buying the dip.
So the next one is, of course, Qantas. Now, this is a very similar play to the Carnival Cruise Lines one. For anyone that doesn't know, Qantas is Australia's biggest and best export in terms of airlines to the entire world. Now, I didn't actually own this one prior to the stock market crashing back last year, but when I saw it got down to an absolutely ridiculous level, you just have to buy it. It makes sense because it was such a deal. So I saw that the stock price got down to, I think it was $2.20 roughly, and I was buying around that level. So since then, it's gone up quite dramatically, and I've sold out of that position for about a 70% gain. So another one that I'm really happy with. Now, this next stock is the last one I'm going to talk about, and it was an absolute home run. And very much in the same situation as before, there was a real fear around last year when the entire stock market was crashing. We saw a decline, I think, of the S&P 500 of about 30%, which is quite a big drop. Now, during this time, there are a lot of companies that were selling off massively that for some reason they shouldn't have been. I think people were just trying to dump their stocks and get out in fear that they would go lower. Now, this particular company is an e-commerce company. And during this time when everything was selling off and everyone was locking down, I was like, well, people are going to be at home. The only way they're going to be able to buy things is if they're like looking online and purchasing online. And this is a particular sector that the company that I'm talking about right now was heavily focused on. And so I thought it was just crazy, and I didn't think the lockdowns would really affect them too much, because if people are at home, they're going to be bored and they're probably going to be buying stuff, especially with all the government support that was getting announced at the time. Now, this particular company is Revolve. Now, Revolve is a company that offers mid to high-end clothing, specifically targeted at females. They use a lot of influencer marketing. So I was buying this stock at about $16 a share, and then the pandemic just crushed it, and the stock was around $7 to $8, and this is where I was loading up really heavy. And it's really important to note that the reason I could do this is because I had cash lying around. So if you are investing, it's really important to make sure that you have cash on the sidelines ready to go in case something happens. And that was exactly the case in this situation. So Revolve, I loaded up heavily around that $7 to $8 mark. And since then, all you need to do is have a look at the stock chart, and we got a return of about 550% on that investment, which was just crazy. That's a home run stock. If you're getting anything that's over 100, 200%, let alone 550%, that is an absolute home run. So thankfully, I was buying at the right time, and it was the right company. I've actually sold out of this position as well, and the stock has continued to rise a little bit, but I just thought it was getting to a point where it was quite overvalued. So at some point, you need to get off the train. And for me, it was this. I have left some gains on the table, but so far, I'm pretty happy with that 550% return. So, of course, I promised you a bonus stock as well, and this particular stock is going to be my worst performing stock that I've had in this financial year. So that stock is the SQQQ, which is an ETF that is short the NASDAQ, which is triple leverage. Now, during the pandemic, I saw that the stock market was crashing. Basically, what I wanted to have was a hedge. So if that market continued to go down, then I'd have this position that would be in the green while all my other stocks were going down. And of course, the reverse is true as well. You know, as the stock market bottomed and there was all this government support, the Fed started printing money, everything started to rise. And of course, this particular one started to lower. Now, of course, this was only a small position because it was a hedged position. You know, I just want to make sure that there was some protection if the stock market continued to fall. So a lot of my stocks rose dramatically. And of course, this one that was tracking the broader market and was a leveraged investment continued to drop. So thankfully I got to a point where the stock market was a little bit more stable, the economy was a little bit more stable, and it definitely looked like it was not going to go back down. And that was the point where I sold out of this particular investment. So while it was a loser, it was down minus 22%. It provided some protection against a falling market in the same way that, you know, you might buy put options in a stock that you own just to protect yourself against the downside of a stock going down. So it's part of a broader investment strategy. So don't fight the Fed and always make sure you have some kind of protection against the downside. So I'd love to hear about your best gainers, seeing that it's the end of the financial year and anything that's been sold, you know, we have to pay capital gains tax on. It's a fabulous time of year. I love it so much. So thank you guys so much for watching. I really hope that you like this video. Please share your best gainers this year and any stock picks that you have going into the future. I'd be really keen to hear about your positions. So thank you guys so much for watching. Like the video and subscribe, and we'll see you later.